Hey everybody, it's me, Alex, Senior Vice President over here at Jet Lending. And as promised, today we are going to go over some more things to help you with your education on how you guys can be acquiring properties and how you can buy them better. So today we're going to talk a little bit about not so much on how to how much like you can do in repairs to make it worth more money, like the after repaired value. Today, we're going to work on what things actually deter value. So, especially in this market, most of you are looking at any kind of deal that's coming down the pipe. Okay, you guys are looking at everything and trying to make it work. And it's understandable, but you still got to buy it at the right price because, like we said in our past videos, purchase price is the only variable that you can control. Okay, so we still got to buy it at the right price and how these properties will appraise, how they can be repaired. And there's some things, no matter what you do, will not change the value. They're going to be deterrents. So you need to be aware of those things while you're evaluating so you know that you don't overpay for a property, or you know that you are now speculating in a market and you understand the risk if you choose to overpay for a property. Some of these things are not so much that worrisome for when you hold them for rent. It's more for when you flip them. But even if you're holding for rent, you got to understand what the appraisal comes in at, especially for your 30-year, whether you're using conventional lending or if you're using jet lending for like non-QM 30-year loans that we do all across the country. You got to understand about how the appraisal is going to be viewed on some of these things. So let's go over some of the most common ones. The first thing that everybody always talks to me, especially at this time of year, all the way up to about November, is flooding. Do flood properties ever rebound? Do they always have a stigma? Yes and no. So if you had a property and it flooded once and it hasn't flooded in some time, and this sounds simple, but you have to know that flooding comes from the ground up. Okay, so if you look at some of the properties from our freeze, maybe a year or 2 years ago, that's not a flood. Okay, so all the pipe bursting stuff like that is not a flood. That's just water damage. Flooding actually has to come from the ground up. Okay, so if your property is flooded, here's some of the things that you need to consider. Number one, how many times has it flooded? Okay, so always try to get a seller's disclosure from your seller on if they have had any kind of reference that the property has flooded in the past. But also just look at some historical data. Did it flood in Harvey? Did it flood in Ike? Did it flood in any time in the history of the property's presence? Okay, there are some parts, there's like especially one part near Twin Lakes in the north side of town, right before you get into the woodlands. Okay, there's this little dip near Twin Lakes. Anything past that, I mean, you can drive around and you just see bare concrete slabs where even the insurance company wouldn't even allow to rebuild the property. Okay, so if you're looking in those types of area and you're holding them, you're probably going to be okay. But to flip them, you know that you have to have way decreased value. And here's the kind of things where even when you're holding them, okay, or selling them, but if you're holding them, you got to know this. Getting insurance for that property is astronomical. Okay, so when you sell the property, you can't just look at ARV value. You got to look at you as the person that's refinancing it, or you as the person that's selling it and the buyer. How much insurance is going to be put on their, PITI for when they get a mortgage? Is that going to kill your deal like 45 days into contracting where they're like, oh, we can't afford this house anymore? So understanding how much insurance costs for a home in the area in which you're trying to acquire is going to be very, very important. So my advice to you is find an insurance agency that is well versed in investment properties. There is a difference. If you ever look for a quote and they keep you'll see like HO on it, it's like homeowners. This is not homeowners. This is an investment property. Usually it's just liability. There's builder's risk, things like that. And then even when you hold it as an investment, it's an investment. It's not a homesteaded property. It's not a homeowner. You are just the owner. I know it sounds confusing. You are the owner of the property, but it's not your house. It's not your primary residence. So there's a lot of great insurance companies in the area, no matter where you're listening to. Just ask them, how many binders have you written, for investment properties? And of course, they're going to say, oh, we do it all the time. Like, okay, well, can you send me some ideas? Look for your lenders you're using. Say, hey, can you send me your insurance requirements for your property so I can tell my insurance agent? There's a couple people in your team that will only listen to you, no matter what title says or your lender says. They won't listen to them. They'll only listen to you. So make sure your insurance agent understands what kind of insurance you're supposed to get. Okay, that's just like a side note. But for floods, what's a good rule of thumb is, one, comp the last 6 to 12 months, like our comp video we did a few days ago. Look at comps and see what's changed in the market. Use those comparables on rehab properties, especially their days on market, to see what's viable in the market for what you're trying to buy. The second thing you can do is, a good rule of thumb would be, if a property is flooded once recently, take about 5% to 10% off the houses that did not flood area. So let's say you're in a subdivision and only part of the subdivision flooded. Well, if there's no solds for a lot of solds that are rehabbed on the flooded properties, take the non-flooded comps and discount it by 5 to 10%. For 2 floods recently, maybe 10 to 20%. 3 floods, maybe 20 to 30% or more. If it's flooded over 3 times, you really got to consider, should you buy this property? Basically, you're living in a canoe. All right. So it's just like, what do you just got to, not say don't buy it, but you have to be under the impression of what this value could be in the market and with an appraised value. Okay. So flooded properties, don't shy away from them, but just be understanding of what their values could be, especially with recent floods. You are seeing, the deals that are in Memorial and stuff like that. The values are bouncing back, and there's not been a lot of issues since Harvey. But you still need to be aware of it, and you got to really also remember, price your insurance. The next thing that you have to really consider, and we'll say this, you'll watch 10, 20 of these videos, and I'll always mention it, is busy streets.
I don't have an answer for that.
See? Busy streets are one of the #1 deterrents of value, and it snags a lot of people on their evaluation. So if you are an investor, and let's say you are looking at a property and it's on a major street, I always say, because these are the ones I can just remember offhand, like TC Jester or Ella or Crawford, anything that's just a major intersection. Like, you'll drive 5 minutes and you're in a completely different area of the city because it's just a major road. Okay. One of the things that you need to really understand is that is a major deterrent of value. It will increase your days on market. You cannot use the comparables within the subdivision, anywhere from 3 to 5 houses within the subdivision from the busy street. Those houses are going to be worth significantly more than the one that's on the busy street. I understand you're going to do the half moon driveway and all that kind of stuff, but it's not going to improve value. It will help on your days on market, but most likely your property is going to be worth about 20% less than 3 to 5 houses from the busy street into the subdivision. So if there's not a lot of busy street comps, let's say we're on TC Jester, and you take comps about 1,000 units plus or minus your subject. So if you're at 1322 TC Jester, you're going to look at 2322. You're going to look at 322 TC Jester, because you don't want to go too far out, because you know that if you drive 10 minutes on TC Jester, you're going to look at a lot of different types of subdivisions, a lot of different types of values. So just range it a good tight area, especially if you have corresponding major streets and landmarks. The market's changing. Keep tight within that area and comp those first. if you can't get enough data, you can comp the subdivision in which it's behind, okay? So if you have TC gesture, one direction is going this way, one direction is going this way, there's a median, and your house is down here, don't take, if the subdivision reaches back over here, don't take those comps. Take the one that's south of it. Take all the ones over there because that's more comparable to what your subject property is. So you can take the subdivision comps, but know that's going to be about 20% less on average. So if your average house sells for about 400,000, you know, and you take about 20% of that. So let's say so your property most likely on the busy street is going to be worth 320. Okay, so don't get fooled about, well, you know, look at all these comps, they're worth 400. Yeah, but mine's on a busy street. So always make sure that you pay attention to busy streets. Not only was it going to be an increase days on market, but it's also going to be a decrease in probably value. All right. Commercial. So if you're working in the residential space, and so 1 to 4 single family, all right. If your property for just single family and a flip, okay, is next to an apartment complex, it's across the street from a liquor store, it's behind an HEB, anything commercial like that, it's going to reduce its value. The opposite is for commercial. If you're close to those things, you're on a busy street, it's going to raise your value. So the thing is doing with the busy street was more about just residential, not commercial. Even like if you have a apartment complex and it's on a busy street, most likely it's going to be worth more money, granted that there's parking. Okay, so commercial adjacent to or facing your subject property in single family 1 to 4 residential is going to be most likely going to detract value from that property. Depending on what type of commercial it is and how busy it is would be the percentage of the detraction. You're looking at probably 5 to 10% reduction, okay? Because the interesting thing is, it's even happened in my neighborhood where commercial people that are on the feeder road will actually buy houses within, just behind the parking lot, and buy them for 2-3 times more than anybody would ever buy a single family home for. So you got to make sure you can see on MLS, sometimes those are still marked as a sale. You'll see, oh my God, this property sold for $800,000 and the average is $350,000. Don't use that comp because that was a commercial purchase. Okay, so you got to be a little bit, wiser for the wear on how things were purchased. Another thing we'll go over is add-ons. Okay, add-ons are fantastic ways to improve value. If and only if you make the add-on look seamless to the structure. You all have been into a house where either one, you walk into a room and it used to be a patio, and you know that because it's an exterior door, there's a window to the kitchen, it's closed in, I guess. There's brick for a wall because it was the outside of the house. You can't count that as added square footage. No one's going to count that. The appraiser's going to count. I mean, especially if there's not at least 7-foot ceilings, it's not going to happen. All right. So make sure, you walk in, there's drop ceilings. Everything else is sheetrock. And this room has drop ceilings. All right. I'm not saying don't buy it, but you got to fix it. You got to make it work correctly. You got to make it seamless with the house. So I'm not saying don't buy those houses. I'm saying that you need to increase your repair budget to make this look seamless with the property and make sure it's permitted and you're within code to make sure that you can do that. Because there's plenty of people that got stuff done that nobody knows about, and then all of a sudden you bought it and now it's your problem. So that's why I'm doing these videos, so you guys know, wiser for what you're trying to do. Add-ons are, again, great. Like garage conversions. The one thing that you got to be worried about in garage conversions is if every other house in your subdivision has a garage and yours does not, that is the time you have troubles with garage conversions. Okay, you have to have something that it has to look seamless with the house. The exterior has to look seamless, like it was meant to be. When you go into that house and you have to take 2 steps down because this is the master, that ain't going to work. Okay, that's going to really hurt your days on market. That's going to hurt your values. So when you look at these things, again, I'm not saying don't buy them. I'm saying that you have to adjust your cost structure on repairs if you do so. And when you're buying them, buy them at the current square footage. So if someone's like, well, this is a 2,000 square foot property. And like, well, how much square feet is this room? 500. This is a 1,500 square foot property because this is not an add-on. This is just some guy that put up wood and covered the outside and called it a room. Okay, so just make sure that you're always doing what you need to do to protect yourself. So you're going to buy things at its current square foot to make it its new square foot value, because you have to do a bunch of work. That's why we're buying these things, because they're distressed and they're banged up. So don't shy away from this stuff, but you need to know this. So you need to be well informed about what to look for that decreases the value. So if you buy that added square foot property, know that 1, it has to look seamless with the house. 2, if you buy it, and let's say they did have some sheetrock up, and you open the walls and the permit office comes, just know that you have to make sure this is up to code. You have to make sure that everything that you're doing and what they did is fixed. You're going to make a good quality product. Okay. So just know that you always have your contingencies on any kind of, oh, we made an upstairs garage apartment. Great. Was it permitted? I don't know. Okay, well, I still want to buy this, but man, I'm going to tell my rehab group, listen, you got to put some money away in contingencies because I don't know what they did, and to make sure it's up to code. So you need to look underneath. You see, did they joist it correctly? Did all this kind of stuff? You'd be surprised what people do. And now you bought it, and you just got to fix it. Just do good, ethical, clean work. Make a good product. And that's why I'm doing this. You guys are wiser for when you evaluate properties on what could be increase and decrease your property value. There's plenty of things that we can go over, but those are some of the major ones that you guys should really know about. Okay, one like a side note, one is school districts. Just be aware of your school districts for rentals and flips. If you're in a good school district, you're probably going to be okay on days on market. A bad school district, you should just be aware of it. It's going to affect value. There's a great area right near our office called Ponderosa Forest, and it's Spring ISD, and it does deter people, but it doesn't deter it enough for value. I mean, I'm not saying people haven't made money and sold great values over there. It's not what I'm saying. You need to be aware of it. So you make sure you don't take something from Klein ISD from a similar property and like, oh, that works. Just make sure you're nice and conservative with your values so you're not burnt on some of these variables that you didn't attend to. Okay, so I hope this helped. If there's any reason why you guys need more help, and you're like, listen, you're not going over what I want you to cover, let us know. One of the things tonight, this is, by the way, just in case you're watching this in the future, it's April 20th, 2022. I just put a link to our short-term rental hold meeting for the super investor meeting that's online tonight. Feel free to watch. We have Rehab with Ehab, talk about how he built an empire in short-term rentals and how you can do it. So if that interests you, click that RSVP that I put in the chat area and join us tonight, network, and ask questions live. Okay. Please like our Facebook page or subscribe to our YouTube page for all this educational content. If there's anything that you need, give us a call here at Jet Lending. You can text that same number. You can go to our website, whatever you need, and we'll be there for you. Again, we're going to keep pumping out more content for you guys so you guys be better in the know on how you can make money in any market.